Hey everybody, it's Anthony Fletcher. Thanks for coming to my channel. Today I am outside, out of the area. Kind of, you see where I'm at the ball fields. I have kind of a small side hustle job where I kind of go out there and relive times coaching, refereeing, and having watched my kids grow up on these fields. So I help paint these and take care of these fields on a regular basis. So I want to talk to you today about three different non-conforming or conforming loans, that you should think about if you're looking for your first-time home buyer. These are not government loans, so these are done by Fannie Mae, Freddie Mac. And basically, as far as the loans are concerned, you need to think about these will require 3% down. You do have to have a 620 credit score. They are based off conforming loan limits, so you'll check those in your area. And also, you may have to take a class in order to qualify for these programs. And it does have to be your primary residence. So all three of those require this program. So let's kind of get into them. The first one is called the conforming 97% loan to value. Now, the great thing about this particular program is that it does that. You only have to bring 3%. You can be your first time home buyer or repeat home buyer. There's no issues whatsoever on that. And also, as far as the program is concerned, it's a great program that if you were to, let's say, own a current house and you want to go buy another house and you don't have the funds to pull cash out of it, and let's say you want to keep your other one as a rental, this is a great program, so you only have to put 3% down. And then you can also, with that particular deal, you can also use 75% of the rent you get from your previous home in order to be able to help you qualify. And this particular loan also does not have income limits, which is fantastic. So you can make as much money as you want and still qualify. Now let's kind of go into the other two. The other two, one is called Home Ready and one is called Home Possible. One's Fannie Mae, one's Freddie Mac. They're both based of having income restrictions as far as you can make. They're basically made for low to moderate income based off the 80% rule. And you can find out what the 80% amount is in your particular county if you just go onto Google and you can just type into county and put that information in. It'll tell you what it is. And these two programs offer usually a little bit lower at interest rate than if you were to do that first one. Also, only one borrower needs to be a first-time home buyer. So let's say if you were to own a home before and you had sold your house and then you got married and you were buying another house with your wife, well, you would qualify for this because one of the homeowners do have to be first-time home buyers. Now, another great thing about this program that a lot of people don't know, actually that you can use border income. Now, what border income is basically income from renting a room or two inside your property. So regardless of how many rooms you have, the more borders you have, you can use it. You can use it up to 30% of your total income. So let's give you an example. Let's say if you purchased a home, you owned a home before, let's say that you rented a home before and you were the primary person renting the home. And then what you did is that you had two friends that rented two rooms of $600 each for a total of $1,200. Now, let's say you're going to go buy a house, and you're going to use this border income. So if you can document for 12 months the amount that you've been renting this property for, the extra two rooms, and they've been paying you directly, so they pay you and then you pay the actual landlord, then if they decide to move over with you, you can use that income. So in this case, you can use up to 30%. So if your total income was $4,000 with them, then $1,200 could be their portion of the rental. So it's a phenomenal type of program that a lot of people don't take advantage of, and a lot of people should take advantage of it. Another type of program that is eligible that a lot of people don't use is it's an ADU. So what it is a lot of people are out there looking for a place for maybe a family member, a retirement person. Let's say I'm getting older and my kids want to buy a house and I want to live in the back unit. So they can buy one with an ADU on it, and if there is a renter in there currently, you can use up to 75% of the money from that renter in order to help qualify. So that's a great, fantastic way of being able to help qualify for you to buy this particular house. And then maybe down the road, when the rent comes up due later down the road, maybe what happens is the retirement, your family member then moves into the property. So that's a fantastic way. Now, one thing that is terrific with both of these two programs, Home Possible and Home Ready, is the 3% down can be your money, and it can be a gift money. You can use seller concessions to help pay for your closing costs, and they all are pretty easy to get to and get the loans. Sometimes the rates, like I said, are a little bit favorable, and the fees are a little bit less expensive when you go Home Ready and Home Possible versus the conforming 97%. And the mortgage insurance sometimes is a little bit less expensive too. The only pitfalls you do have with these 97% particular loans is that they are credit score driven. So if you have a lower credit score, sometimes the rate and also the mortgage insurance can be a little bit more expensive than going FHA or USDA, if you can use that particular program, or VA. So there you go, everybody. Hope you enjoyed this quick video on this program. Hopefully you're getting outside and enjoying the day like I am, and we'll see you again on our next video. Thanks again for tuning in, and if you do like it, please hit that subscribe button, and also please like the video. Let me know if any comments, questions that you might have. Have a great day. Bye now.